Previous class we were discussing about important monetary instruments of credit control by RBI, which there were two types: quantitative method and qualitative method. As we have already discussed, the main function of Reserve Bank of India is to formulate monetary policies, to execute monetary policies through certain monetary instruments, and this is done to achieve certain monetary objectives like price stability, to reduce the money supply in the economy, to achieve growth. There are certain monetary objectives which we will study in detail, for which RBI is trying to execute these monetary policies and to achieve those monetary objectives, and this is done through commercial bank. Supply of money is being decided by RBI, and all the monetary policy will be executed into the general public through commercial bank. So these are some of the quantitative methods which we discussed in the previous class. First one is bank rate, open market operation, variable reserve ratio, which includes SLR and CRR. I think we discussed bank rate and open market operations. For all those who had connection issues and all those who couldn't listen to the lecture completely, I'll just summarize what is bank rate. Bank rate is the rate at which central bank gives loan to the commercial bank. Just like we go to the commercial bank and take loan, and there is a rate of interest which we need to pay on those loans, same way commercial bank goes to central bank and takes loan. For on that loans, the rate of interest is known as bank rate, and this bank rate has effect on all other rate of interest into the economy. And RBI will use this bank rate according to the economic condition. If it is inflation and RBI feels that the money supply is too much in the economy and money supply has to be brought down, or inflation has to be brought down, RBI will increase the bank rate. When they increase the bank rate, it becomes very costly for commercial bank to get loans from central bank, as they have to pay more bank rate. So this will reduce the demand for their credit from RBI. So this in turn, commercial bank will apply it over the general public by increasing the rate of interest at which the general public will get loans from commercial bank. So RBI will increase the bank rate for commercial bank will increase the rate of interest on loans for general public. So it's a chain reaction what is happening. So like this, RBI is indirectly through commercial bank, they are trying to control the money supply in the economy. This is what we studied under bank rate. And opposite will be the condition if it is deflation, or if it is a deep depression condition is happening, economic condition is very bad and money supply has to be instilled into the economy. At that time, bank rate will be reduced. When they reduce the bank rate, now commercial bank finds it very easy to get loans from central bank. When they get loan easily from central bank, even they will reduce the rate of interest on which general public will get the loans. So this we have already discussed. I'm just summarizing it. The next one is open market operation. Just like when I sell some product to you, and I'm selling a product to you and you're giving me money, so I'm taking away your money and giving a product. Same way, sale and purchase of securities will be done by central bank to the commercial bank. Commercial bank will have to buy the securities which has been sold by RBI. So when they do that, their reserves which they have kept for giving loans to the general public reduces. So their loan giving capacity to the public reduces, and this is the condition when happens when there is a excess money supply in the economy, or where there is inflation happening in the economy and RBI has to reduce those. So sale of securities happen when money supply is more in the economy and RBI is trying to reduce those money supply. Buying securities happen when there is a deflation situation and money has to be instilled into the economy. RBI will buy the securities from commercial bank. When we buy something, what happens? Then they will get more money, right? RBI, when they buy it, they have to give money to the commercial bank. So commercial banks loan reserves which they can give to the public increases, so they can give more loans to the public. See, basically when they give more loans, investment increases. When investment increases, production increases. When production increases, income increases. That means people are having more money with them now. Thus, the deflation or price reduction or lack of demand condition can be solved by sale and purchase of securities by central bank to commercial bank. Chalo. So we stopped here the previous class. We are going to deal with the third quantitative method adopted by RBI through commercial bank. How do they do that? Variable reserve ratios. Variable reserve ratio is like every commercial bank are being directed by RBI to keep certain reserves or deposits with them in the form of cash with RBI or with themselves. So commercial bank has to keep certain amount with them as deposits or reserves which they are not allowed to give out as loans or circulate it into the economy. They have to keep a bit of their money as reserves or deposits as directed by RBI. So there are two kinds of reserves which every commercial bank has to keep accordingly with the directives of RBI, which are cash reserve ratio CRR and statutory liquidity ratio SLR. So basically CRR and SLR are two reserves or deposits kept by commercial bank as directed by RBI. So let's go to what is CRR and how does it affect the commercial banks actions towards public. So CRR is a reserve or deposit commercial bank has to keep with RBI. So when commercial bank has certain set of reserves and they can use half of them to give for loans and the rest of them commercial bank has to keep reserve and deposit with RBI. Accordingly, RBI will change the percentage or proportion of CRR according to the economic condition. Suppose if the money supply is more in the economy, if it is inflation in the economy, now RBI has to decide on CRR. Suppose if it is just like the bank rate, CRR will be increased. Suppose it is inflation, suppose the money supply is more in the economy, CRR will be increased. CRR in the sense more now initially suppose the previous term CRR was just 4%. Now the CRR, if the money supply is increasing and inflation is going up, RBI has to do something. CRR from 4% it is increased to 10%. Now commercial bank has to keep 10% of their total reserves as CRR. They have to keep it as reserve. 10% of their deposits have to be kept as reserves. So as cash. So what happens, when they increase their reserves, it will reduce their loan giving capacity to the public. Thus it will help in controlling the money supply into the economy. Opposite will be the situation when it is a recession. When it is recession, the main problem in the economy is that money supply is very less into the economy and deflation prices are going down. Now RBI, when they come out with a monetary policy or monetary instrument, their only aim is to increase the money supply in the economy. How do they do that with CRR? They will reduce the CRR. Now it was 10%, CRR was 10%, they will reduce the CRR to 4%. Now the commercial bank has to keep only 4% of the reserves as cash with RBI. So now they have more money to give as loan. They can give more loan to the public. They will give more loan, investment will be increased, production will be increased, income will be increased, people will be having more income with them, which will result in increase in demand and the prices will increase. So that deflation situation will be covered. So CRR are basically reserves or deposits kept by commercial bank with RBI in the form of cash. When they keep more CRR, they will be left with less money to give as loan to the general public. According to the economic situation, if it is inflation, CRR will be increased. If it is deflation and money supply is less in the economy, CRR will be reduced. So this is how RBI tries to change CRR and control the money supply in the economy. Let's move over to SLR. What is SLR? Statutory liquidity ratio. So SLR is proportion of reserves or deposits commercial bank has to keep with themselves for liquidity. So CRR was deposits or reserves commercial bank has to keep in cash with RBI. Here SLR is that kind of reserve or deposit which a commercial bank has to keep with themselves. Why they have to keep it with themselves? Because to solve the liquidity issue. Best example is S Bank. See, many of the banks, what they do is that they give loan on the basis of the deposit they get. They doesn't keep these reserves, and total amount will be just circulated as loans. Whatever deposit they get, without even keeping proper reserves, they just give it as loan. At certain point, what happens, they will face the liquidity issue, where suddenly if there is the bank is any problem happens in the banking system and people do demand back their deposits, they will have problem, because already whatever is being deposited by the people has been circulated as loan to the general public. So if certain that kind of liquidity issues happen, for that reason only RBI is asking commercial bank to keep certain set of deposits for liquidity issues. So whenever a liquidity issue comes, they have the reserves to solve that. So that is what statutory liquidity ratio means. These are deposits where commercial bank has to keep with themselves to solve the liquidity issues. Commercial bank use this deposit to buy RBI security. Whenever there is an excess liquidity issue in the banking system, SLR will be increased or decreased accordingly. Suppose SLR has been increased, that means more deposit has to be kept by commercial bank with themselves, and lesser will be amount available to give as loan to the general public. So same like as CRR, when CRR rate has been increased, it reduces the commercial bank's capacity to give loan. Same way SLR also, when increased, commercial bank will have less money with them to give credit to the public. So when it is recession or money supply is less in the economy and RBI is trying to instill more money into the economy, what happens? SLR will be reduced. So central bank will say that now there is no need to keep much money with yourself to solve this liquidity issue. Give all whatever is left, to give it as loan to the public. So when SLR has been reduced at the time of recession, commercial bank will be left with more money with them, so that they can give more loan. The more they give loans and advances, they are indirectly trying to instill more money into the economy through investment. When they give more loan, producers will invest more, they will produce more, income will be increased, and demand will be automatically going up. So these are some of the quantitative methods used by central bank to instill money supply into the economy, or to regulate or control the money supply into the economy. The change in bank rate, the way how they will sell or they will buy the securities, or CRR will be increased or decreased, or SLR will be increased or decreased. All these instruments depend on the economic condition which the economy is going through. If it is inflation, they will increase the CRR, they will increase the SLR, they will increase the bank rate, they will try to sell securities and take back money from commercial bank. But if it is deflation and money supply is less, everything will be opposite. SLR will be reduced, CRR will be reduced, bank rate will be reduced, and they will buy securities and give more money to the commercial bank, so that that money can be used as loan by them to general public. So today we have studied about quantitative method, all these three quantitative method, and how do they affect the general public. So RBI is indirectly using all these methods, quantitative methods, to control the credit into the economy.